Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Chip concerns. Qualcomm falls as stalling smartphone demand as ARM spurs concerns of a slowdown in AI spending. It's yields, not the Fed, that Treasury Secretary Bessent says the administration's focus is on the 10-year Treasury. A decision day for the Bank of England, expected to cut rates and lower its UK growth forecast. Good morning to you. The equity market searched through the wreckage yesterday and decided to lean into the better ADP jobs number over the services numbers. We're up by 1/8 of 1%. Be wary, though. We have the legendary short seller Jim Chanos in the studio yesterday. He said, we are not at the froth of 2021. We'll talk more about the individual stocks in just a moment, but it was a message from the Treasury Secretary which has imbued a sense of confidence in this bond market. Now, yields are up by 2 basis points this morning. I just want to put it in context for you. You have touched the lowest yield of 2025. We dropped by 20 basis points yesterday on the 10s from the highs, as Scott Bessent, the Treasury Secretary, said in his interview with Fox, and he'll be in the studio later today. Trump wants to lower the 10-year yield, not Fed cuts. So the Doge Committee really comes into a sharp focus, and Dan Iverson over at PIMCO says embrace the volatility. For some stocks we are keeping an eye on. Tech again very much in focus, this time on the chip side. ARM falling after the chip design company provided a tepid outlook, underlining the concerns about the pace of spending in AI, down 3.6%. Ford also on the back foot today, warning that profit may fall by $2 billion or more this year due to lower vehicle prices, costly new model launches, and of course the risk of tariffs from President Trump. SocGen shares jumping after the French lender reported results that helped confirm the recovery in the French retail banking unit. And in just a few moments, Sharon joins me from Goldman Sachs. How optimistic is she as we see records made across Europe? And then later in the hour, Nela Richardson of ADP and Anthony Fobel of Arcmont Asset Management. Well, in the absence of new developments on the trade front boosting risk appetite this morning, that's as President Trump delays the imposing of tariffs on Canada and Mexico to early March. Goldman's Sharon weighing in on the big topic with this. We think a further extension is likely, but the tariff risk for both countries is likely to remain until at least the conclusion of the USMCA review, and that's slated for mid-2026. I'm pleased to say Sharon joins us, Senior European Equity Strategist over at Goldman Sachs. Sharon, good morning. Look, the tariff genie's out of the bottle, so I just want to frame this. How optimistic are you that this is about Trump extracting concessions, or do you think we ultimately end up with that sticker price of 25% on Canada and Mexico?
It's a tricky one, isn't it? I just think uncertainty is going to stay high. And as long as uncertainty is high, it affects investment, it affects sentiment for companies, it affects what businesses want to do. So it's tricky to read exactly what Trump will do, but I just think this uncertainty is still going to weigh on growth and weigh on investor concerns. Will he do the 25% for sure? I mean, clearly not. I mean, he's already paused. So it may happen, it may not, or it may happen to a smaller degree. There may be more concessions, more negotiations, but this just keeps tariffs in the news, I guess.
Look, it's like red headlines every day. My favorite line comes from Julian Emmanuel at Evercore. He said, you want to discern the trade war heroes and the trade war weary. Can you just give me a soupçon of what you think the trade war heroes could be?
The heroes as in which stuff could do well
Yes.
in the event of a trade war. Yeah, I mean, I don't think generally, economists will always tell you that you don't gain from a trade war. In net terms, most people will be losers. But I guess that the areas in terms of asset classes that will gain in a bigger trade war, let's say you have retaliation, that say Trump ups the ante on some of these, the rhetoric that he's had recently. Things like gold, obviously, people going to more safe assets like that. The dollar as well probably rises if trade war risks rise. And then also within the equity space, which is what I look at, more defensive areas gain. So to the extent that we do get a bigger trade war, what we tend to find is more quality areas, more defensive areas tend to outperform rather than more cyclical areas.
Sharon, just hold that thought. We've got a little bit of breaking news coming through on Honeywell, actually. I just want to bring this to our audience. So Honeywell is to break into 3 independent companies. This is according to Wall Street Journal. The headline that they have is Honeywell to break in a bid to recreate some of the GE BOE magic. A little bit more on that reporting. We'll bring that to you. So that's a breaking news headline on Honeywell. Break it up and create value. I think that's the theory, isn't it, Sharon, with these massive breakups and restructures. It's about extracting value. When it comes to the equity market, let's just pivot back to this. The risk from tariffs and a trade war is that you have a growth shock and an inflation pop. And when I think about the equity market calls, those big echelons, 6,500, 6,700 and 7,100 here in the US, that is predicated on a status quo or a Goldilocks kind of growth environment. Has that shifted at all for you?
Yeah, I mean, we call it price for perfection. Goldilocks is another potential name for it. So it's an environment where you have disinflation, certainly inflation's not going up, and you have good economic growth. And you also have good earnings as well from individual companies. And all that mix gives you high valuations and very good returns, and that's exactly what we've had, at least for the last couple of years in the US. Of course, valuations have now gone up quite a lot. They are high, and this is where we say price for perfection. But then again, the US economy kind of so far has delivered that type of perfection. We have had inflation fall, we have had rates come down, we have had good economic growth.
Is perfection challenged in that case, Sharon, if there are no rate cuts? This was a theory in the summer last year, we don't need rate cuts to continue price for perfection. But that narrative is shifting, isn't it? Yeah,
I mean, I feel that you do need some rate cuts this year, or rather, maybe put this another way, you do need to see a continued sign that inflation is coming down, is moderating. If these tariffs, and we still don't know, it's a lot of uncertainty, as said, if these tariffs are imposed in big style and there's retaliation and all of that, then that will be inflationary. So, and the market's still unsure, as we've been discussing about that. So if you've got higher inflation, this, I mean, the Fed might look through it a bit because they might see it as a kind of one-off, one-year rise, but still I think that will worry people.
Well, the Treasury Secretary was on Fox yesterday afternoon. He'll be in this studio a little bit later on today. Let's just take a listen to what he had to say. He had some big messages. Let's just take a listen.
They did a jumbo rate cut, and the 10-year rate went up. Now I've seen this year, despite the growth estimates going up, 10 years coming down, because I believe the bond market is recognizing that, as you and I talked about, energy prices will be lower, and we can have non-inflationary growth. We cut the spending, we cut the size of government, we get more efficiency in government, and we're going to go into a good interest rate cycle.
And to be fair, those bonds, those 10-year bonds, are down 20 basis points from their high yesterday. For an equity analyst like you, when you hear Scott Bessent doubling down on 3% growth, 3 million barrels a day in terms of liquids or oil equivalent, and a 3% deficit, what does that do to the equity narrative? Because it's leaning much more into the Doge narrative, isn't it?
The idea of you're cutting costs, you're also expanding oil supply, and that gives you an environment where you can retain this Goldilocks perfect growth scenario, where you can grow but also bring down inflation, etc. There are other things, of course, that he didn't mention, which the US government are looking to do that will be a bit more inflationary, such as the tariffs that we've been talking about, such as also tightening up on migration, because of course that reduces your labour supply, and that will be inflationary. So I think it's a bit more of a balance.
Well, let's see what he's got to say today. One thing that caught my eye, there's records abound in Europe. You just look at the earnings upgrade for Europe relative to where we were last year. I mean, the underperformance of Europe last year to the US was significant. That has flipped around. I just wonder, is that a tail trade that moves to the middle of the bell curve?
Yeah, it has been a long time that Europe has been an underperformer. You could probably even count it back to the financial crisis. Since then, most of the time, Europe has underperformed, and underperformed really badly in the last few years. And investors have been super skeptical. I mean, when we survey investors, we've done polling at our various conferences earlier in January. Everyone is underpositioned in Europe. Nobody particularly likes Europe, etc. And the valuation discount to the US is very, very big. So maybe this is Europe's time. The only problem is that European growth, economic growth, is still very lackluster. Germany's still really flatlining, etc. So I think there's a valuation there, and there's a lack of positioning in Europe, which maybe means that investors aren't looking in this area for outperformance. But equally, there's also quite weak economic backdrop as well in Europe.
Sharon, thank you very much. Let's see whether that differential endures. Sharon Bell of Goldman Sachs, and don't miss our exclusive interview with the Secretary Bessent. That is at 1 p.m. and that is from the Treasury Department. Well, we're counting down to the Bank of England decision happening in less than 3 hours. Let's get to London. Lizzie Burden is outside the Bank of England. Lizzie, good morning to you. Good afternoon. We are expecting a rate cut, but it's the outlook for the economy that's perhaps going to be a little bit more beefy for us today, isn't it?
You're absolutely right, Manus. Let me just situate the UK for you in the context of what Sharon just said, because we've got a touch of the US issue and a touch of the euro area issue. We've got weak growth, but we've also got a short-term pickup in inflation. So a unanimously expected cut today, but as you say, really a focus on the forecast, and stagflation is what is expected there. I would note that the forecast is based on the market curve, which is presumably out of date by now, and Andrew Bailey is surely going to have to pick up on that in the press conference, or else, unless he pushes back against the market curve, it would seem that he's criticising Chancellor Rachel Reeves, because the expectation is that they're going to downgrade growth and raise the inflation forecast. Stagflation, in short. And it's not a good look for the Chancellor, given that growth is the government's top priority, and it may be that that payroll tax rise in her October budget has added to inflation more than was initially thought. The other reason, Manus, why they'll be watching these forecasts so closely from Downing Street is it'll give an indication of how much headroom Rachel Reeves has left. Of course, that's officially decided by the Office for Budget Responsibility, but it will give us a clue as to whether she's going to have to choose between spending cuts, more tax rises, or breaking those non-negotiable fiscal rules. The other thing is, though, I'm sure that Andrew Bailey's going to be asked about tariffs in the press conference. He loves to talk about how he has a passion for free trade, but our economists reckon because the UK isn't directly expected to be hit by tariffs at the moment, there'll be in any case a hit to growth. If we are directly hit, then it would also hit inflation, and therefore the Bank of England wouldn't be able to ride to the rescue as much of the UK economy. But it means that the forecasts might already be too rosy because they cannot integrate the impact of policy that hasn't yet been made.
Well, President Trump already a little bit more complimentary about Keir Starmer than he is, perhaps, let's say, about some of his neighbours. So maybe it won't be just as aggressive. Of course, we wait to see for Europe and for the United Kingdom. Lizzie, great work. We'll see you later on through the day. That's Lizzie Burden at the Bank of England. There are other stories trending on your Bloomberg terminal. Let me just bring them to you. Bloomberg sources say that a consortium proposing to take over Seven & I Private has tapped Citi and Bank of America for financing. Now, their role in the bid would be to refinance the debt and the company's US unit. Representatives for Citigroup and Bank of America did not immediately respond to requests for comment. Chinese retailers that sell on Shein and Temu say that they've been asked to start paying an additional 30% levy on goods imported to the US from China and Hong Kong. This is after President Trump's tariff hike. The vendors received notifications about the new prices they would be charged by the logistics agents. That was late Wednesday night, according to a memo seen by Bloomberg. McKinsey partners have been questioning the consulting giant's presence in China as the tensions with the US rise. They argue that the lucrative North American business can be more than offset any China retreat. Sources say some senior partners have been voicing their concerns since late last year, even before President Trump was elected. Qualcomm's on the back foot this morning. The pre-market trade shows the chip maker's latest earnings raise concern about the slowing smartphone demand growth, and the company expects the overall market for smartphones to be flattish in 2025. Peter Elstrom is the executive editor for Global Tech for Bloomberg News. Look, we've had a feast of technology. Now we're in the chip world. When you look at Qualcomm, what are they saying to us about the smartphone market? They've got a big relationship with Apple. What's the top take on this? What's the spook?
Well, Qualcomm did offer this quite cautious outlook, as you say. The smartphone market, of course, went through years of very, very fast growth. More recently, it's been pretty sluggish across the world, where you've seen flat growth, you've seen declining growth in a number of years, too. And Qualcomm is quite a bellwether for that market. They have more insights into what's actually going to get sold there and what's not going to get sold there. So having Qualcomm come out and the CFO said they expect either a flat market or single-digit growth in the market, which is pretty conservative for the smartphone market, because their fate is so closely tied to that smartphone market. That's a pessimistic outlook for them. But more broadly, it raises questions about growth in the smartphone market and the tech industry more broadly.
Look, the tech industry is grappling with what DeepSeek means, with what the Chinese advancement means. If I look at ARM's overall report, you've got Rene Haas really sort of trying to talk up the AI component with, you know, a chip design being sort of slightly tepid on the outlook. How did it balance out there?
Right. Well, ARM is another company that was for many years tied very closely to the smartphone market. They kind of grew with the smartphone market. Now, Rene Haas, as you say, has these strategic initiatives to be able to get into a number of different markets. The most important, of course, is AI. He wants to be able to capture some growth in that AI market, perhaps delve into the territory of NVIDIA in particular, capture some of the value that those companies are getting. So far, it seems like the pace of entrance into those markets has been a little bit slower than investors would like. They have both the smartphone market holding them back a little bit, and then in terms of that growth in the AI market, it's been a little bit sluggish. Overall, I'd say the big question for investors this quarter is whether these huge investments that companies are making in AI are going to pay off in the long run. We haven't really seen much of that so far. Investors are still waiting for those positive signs.
Okay, Peter, thank you very much. That was Peter Elstrom on the very latest from the chip world. Coming up on the show, toning down the White House attempts to shift the tone around President's controversial Gaza proposal. Context next on Bloomberg.
The U.S. will take over the Gaza Strip, and we will do a job with it, too. We'll own it and be responsible for dismantling all of the dangerous unexploded bombs and other weapons on the site.
That was President Trump on Tuesday. Here's what the press secretary, Caroline Leavitt, less than 24 hours later had to say.
The president has not committed to putting boots on the ground in Gaza. He has also said that the United States is not going to pay for the rebuilding of Gaza. His administration is going to work with our partners in the region to reconstruct this region. And let me just take a step back here, because this is an out-of-the-box idea. That's who President Trump is. That's why the American people elected him. And his goal is lasting peace in the Middle East for all people in the region.
Now, that was Caroline Leavitt, and this is the nuance is important. We've gone from the president talking about doing what is necessary, long-term ownership, and then in the press briefing yesterday, it was about would the president commit to U.S. troops in Gaza. And this is where the nuance really is important. You've had considerable pushback from Russia, from China, from Germany and Saudi Arabia. And this is where they're trying to walk back those sort of perhaps overreach statements from the President of the United States. Antonio Guterres, the UN head of the UN, has said that at a meeting on Wednesday, he said it is essential to avoid any form of ethnic cleansing. And again, this is the accusation that is being made as both Bibi Netanyahu and President Trump sat in the Oval Office yesterday. And again, this is trying to understand the scale of desire by President Trump to participate across borders outside the United States of America. We will talk more about that a little bit later in the show. Let me just show you, we are in Bank of England day. We're waiting for a rate cut from the Bank of England. We're counting down to Jobs Day tomorrow in the United States of America. We've had ARM, we've had Qualcomm, you've had a mammoth amount of technology companies coming with the report. Yesterday it was about the downside for Alphabet, Google, down 7-8%. Let me just show you the cross assets this morning. This is what we've got for you. S&P 500 up 0.2%, and the dollar index up 0.25%. Let's return to our political story. Kevin Whitelaw is standing by for us. Kevin, this step back by Caroline Leavitt, this is perhaps trying to undo some of the verbal overreach by President Trump?
Yeah, I mean, this is something we have seen from the president before, particularly in the early days of the first term last time. He gets ideas. He wants to put them out there. They come from, various places. This one may have well come from his son-in-law, Jared Kushner. And then everyone sort of has to scramble and figure out, what it means and what is actually doable. And I think the immediate reaction, particularly the swift reaction from Saudi Arabia, showed that this was really pretty much a non-starter in the region. And so now they're sort of backpedaling to sort of figure out what that actually means. I think the deeper issue is Trump came into office saying that he wasn't going to get the U.S. into more foreign entanglements. And so, that made this Gaza thing look particularly sort of out of step.
Kevin, thank you very much. Kevin Whitelaw. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manus Cranny. Let's set that agenda. Chip concerns. Qualcomm falls on stalling smartphone demand as ARM spurs concerns of a slowdown in AI spending. It's yields, not the Fed, that Treasury Secretary Scott Bessent says the administration's focus is on the 10-year Treasury. And don't miss our conversation with private credit with Arcmont CEO Anthony Fobel. So, stocks this morning, we just had Goldman Sachs, Sharon saying you are still priced to perfection. There's an uninterrupted view of the upside at the moment. Stocks are higher despite ARM and Qualcomm on the dip this morning. So we searched through the wreckage, the tech wreckage yesterday, and we've managed to balance ourselves out, in part because of the drop in 10-year government bond yields. By the way, roll it over. 10-year notes dropped by 20 basis points from the high yesterday, solidly breaking through this 450 level. You had lighter data on services and new orders, but it really was then, as the day went on, Scott Bessent, the Treasury Secretary, talking about wanting to lower. Trump wants to lower 10-year yields, not Fed cuts. It's about deficit reduction. It's about energy production. And those narratives play into controlling the deficit and getting it down to 3%. How you get there from a debt to GDP ratio of 6.4% is the tougher question. PIMCO are saying you want to embrace the year of volatility, but be respectful of it. Well, the U.S. labour market, we're counting down to the jobs report tomorrow, of course. American companies adding more workers in January than was forecast. This is the private payrolls rising 183,000 last month, according to ADP Research Institute. I'm pleased to say, to take a closer look at the data and set the table for the jobs report, it is Nela Richardson off. She is the chief economist at ADP. Nela, good morning to you. Can you square for me your data, 183,000, the 6 month is moving quite nicely. Then I look at the services side of the equation yesterday, and that slowed, and I've got jolts dipping as well. Can you just square the circle for me on the outlook?
Good morning. And yes, the headline number is very strong, but there's a lot to square underneath the surface. So let's start with that service number. We saw growth in those industries that were oriented and consumer facing. So that includes leisure and hospitality, over 50,000. And again, trade, transportation, utilities. So think retail trade, warehousing. That was a strong market this time around. But where you saw weakness is in business services, so professional business services, information services, less activity, and then manufacturing actually shedding 13,000 jobs. So it wasn't a holistic strength. We definitely saw weakness. As long as the consumer is resilient, the consumer is guiding hiring in the labor market right now.
Is it too soon to say that the blue-collar pressure that we saw last year is morphing into a white-collar problem? Is it too soon to call that deceleration?
I don't think so. If you look at jobless claims, yes, they are at a historical low, initial jobless claims as a proxy for layoffs, and have been so for about 2 years now. But when you look at continuing claims, people who are still receiving jobless claims, looks like it's taking longer to get a job. This is what we picked up also in the ADP payroll data, that it is taking college degree holders a bit longer to get a job than it did 2 years ago. Remember, in the Great Resignation, jobs were aplenty. We're not seeing job listings in the JOLTS data for these professional business services grow. So there is some weakness in white-collar jobs, and we should continue to track that.
We're at the foothills, as I would say this week, of understanding what tariff risk is and what trade wars could be. When you look back at the previous Trump administration, to what extent did that overlay impact the hiring freeze, hiring delay? What can we learn from Trump 1 that we can perhaps apply to the jobs market in Trump 2?
Right. We really didn't see the slowdown in manufacturing hiring until the last 6 months of 2019. So what we're seeing now, I think, picks up of that pre-pandemic trend. The pandemic period was almost like a hiatus from a general weakness in manufacturing. So in terms of what to look forward to, not necessarily look forward to, but what we're looking for is whether or not those tariffs hit input prices for manufacturers, or whether they're placed on final goods, because that's going to matter a lot in terms of how the industry absorbs any kind of tariffs. And also for exporters, what that means for their business when you combine tariffs with a stronger dollar, does that affect hiring for manufacturers that export abroad?
Now, some of the more extreme modelling around the risk from tariffs is a 1.7% drop in GDP and a 0.7% add to PCE. If we move towards the more extreme of those scenarios, how quickly would that unravel in terms of an unemployment rate that moves towards the 4.5% that the Fed is obviously focused on than where we are now?
If you're looking, Manus, at that extreme scenario, I think that would incorporate retaliatory actions on the part of other trading partners. And in that sense, if we're seeing some sort of global slowdown because of geographical fragmentation that hits the supply chain and reduces trade, that would be not just a U.S. issue, that would be a global issue, and it would feed back into hiring. But that is an extreme scenario, in my view. If you're looking for a more moderate approach to tariffs, what we saw in the first administration, I think companies could navigate a more lenient tariff structure. So we're still looking at scenarios right now. We're early innings in this trade policy, and we'll have to see where it all lands. But we'll be looking at the hiring data, particularly in manufacturing, to see what the effect is on the labor market.
So that sounds as if it's ground zero, even though the services number was lighter for you yesterday. We had Mr. Barkin here yesterday, and he talked about big cap does the capex spending. Small businesses do the bulk of the hiring in the U.S. economy. Is it too soon to see any restraint in small businesses, or how much of a risk is it on the radar for small businesses on hiring with perhaps no rate cuts and the risk of moderate tariffs?
Small businesses are the most vulnerable, in my view, to interest rates that are paused, because they're getting most of their lending, their financing from banks in order to extend those businesses. They're not able to access the capital markets, and so they don't have the same flexibility. And we have seen weakness in small businesses leading up to a fairly strong January. Small businesses are also over-indexed into consumer-facing industries. So if you couch slightly higher interest rates, or interest rates staying where they are now, with a consumer who pulls back, then that's a double whammy for small businesses. So right now, looking at the early part of 2025, we were heartened by the 39,000 we saw for firms under 50, but we're going to watch that number very closely to see if they can manage all these risks in the economy in 2025.
Tell me this, how much more time now are you spending, how much more intellectual time are you spending on AI going beyond just large language models? I look at the ARM results last night from Rene Haas, and he's talking about rising AI adoption emerging in smaller, lighter language models. So it's not just about the huge, beasts of AI. It's about the transmission to the real economy now, isn't it?
It is. And you asked how much time, I spend a lot of time thinking about AI and how it affects the workforce. We look at jobs. Yes, we're talking, Manus, today about jobs, but I think in the future we'll be talking about skills and tasks and what AI and advanced technologies in this bucket will do to our roles. It's not necessarily affecting job creation, but it is affecting task creation and the skills needed to drive the economy forward. So it has a big impact on the worker and the workforce in terms of productivity gains. So we're looking at how do these technologies advance productivity and how does it make the labor force more productive, not necessarily in the numbers this month, but over the long term.
Okay. Nela, thank you very much. Nela Richardson, counting down to the jobs report tomorrow on the back of the ADP. Well, Honeywell shares, as we said earlier, breaking news for you. Reports are that they plan to split into 3 independent firms. The Wall Street Journal says the announcement could come today. Bloomberg opening trade co-anchor Guy Johnson joins me for more. Guy, I love the Journal's headline. Honeywell to break up in a bid to recreate the GE magic. What do we know? What would a breakup look like? And would it be magic? Good morning.
Well, it might be magic. The GE story has been magic, Manus. You take a look at what GE has delivered. Larry Culp has absolutely smashed it. So that company is now worth 4 times what it was pre the breakup. Remember, GE split into 3 divisions, and as a result of which, you've now seen this model potentially now being applied to other businesses. So Vimal Kapoor, the guy that runs Honeywell, he's been talking about this for a year. He's being pushed around by Elliott a little bit to do some sort of a breakup. We've been reporting on this as well. This shouldn't come as a massive surprise. I know that the Journal headline seems to have come out of nowhere, but I promise you it really hasn't. This has been coming for a while. Larry Culp has done such a good job at GE and has created so much value that wasn't there before. There was such an epic discount being applied to that conglomerate that it has to be repeated elsewhere. And Honeywell is one of the most obvious cases in point. So it looks like they're going to split up. 2-3 divisions look like it's going to be likely going to have a materials division. You're going to have the aerospace division, and you're going to have the automotive division. The expectation will be that it is going to be worth significantly more. Now, it's interesting to see the share price has risen this morning, but only by around 4%. If you apply the GE maths to Honeywell, potentially that share price could go significantly higher. And it'll be interesting to see how the market kind of parse the maths and figure out exactly what this all is going to be valued at going forward from here. But this feels like it's early days. It's going to be really interesting to see how this works its way through. But certainly the GE model, there's some logic to applying it to Honeywell. That certainly seems to be the view of the market and management.
I get the sense, if you look at what Elliott said there's an abundance of evidence that simplification of results in better business performance. So that is their narrative. But you look at how long it took GE to get to the end point, and that was really quite a long period of time. I get the sense this will, the sense from this reporting is that this will be shorter and sharper in its execution. As you say, the CEO has been talking about it for a year. How fast do you think that we'll see this transition to the party of 3?
It's a complicated process. It's not something that you can simply do overnight. There's all kinds of back office operations, pensions, all kinds of other things, Manus, that need to be split apart. Where does the debt go? It is not something that you can do easily. GE took its time, got it right, and delivered the right outcome for its investors. And I think maybe that is the model. You want to get this right. Now, whether or not there has been some pre-positioning being done as a result of, as you say, this year-long process, I don't know. But this is not going to be something that happens overnight. Conglomerates are complicated businesses. They could take a while to unwind, and Honeywell maybe no different.
Guy, thanks for jumping on the story there. It's Guy Johnson, Bloomberg Open Trade co-anchor there, joining us on the very latest breaking news. Other stories trending on your Bloomberg terminal. This is what we got for you this morning. Shares of Qualcomm, they're falling after investor fears of slow smartphone growth in the coming year. The company expects the overall market to be flat or increase low single digits in 2025. Now, the forecast fell short of analyst estimates, despite a 17% increase in revenue to $11.7 billion in the fiscal first quarter. Treasury Secretary Scott Bessent said the President Trump wasn't concerned with the Federal Reserve cutting interest rates. Instead, the administration is focused on bringing down borrowing costs. The specific focus, the 10-year Treasury yield. Bessent also repeated his view that expanding energy supply will help lower inflation. Around 40,000 federal employees have taken up the offer from the Trump administration. They will be paid until the end of September if they agree to leave. An official from the Office of Personnel Management familiar with the deferred retirement data told Bloomberg that the number was growing. The deadline, to apply for the scheme is the end of today, Washington time. Coming up, Anthony Fobel of Arcmont, CEO, explains to us how he navigates the uncertainty of President Trump's second term in private markets, right here on Bloomberg. Bloomberg Brief, I'm Sharon in New York. Now to the world of private debt. Our next guest writes that there is no certainty in terms of Trump. Nevertheless, we are actively incorporating our views on this developing topic, particularly in constructing an appropriate downside case when evaluating any investment. Anthony Fobel is the CEO and the founder of Arcmont Asset Management. Arcmont has 31 billion euros of assets under management. Anthony, good morning to you. Great to have you with us.
Good morning.
You have perhaps the greatest base of businesses that have exposures around the world. How are you modeling your current portfolio of companies to the risk of Trump tariffs?
Sure, and not surprisingly, it is something we're looking at very actively. At Arcmont, we are very much focused on mid-market European businesses. So one of the analyses we carried out was to see what exposure we have directly to trade with the US. And perhaps not surprisingly, given the focus of our businesses, it tends to be much more national or European focused. So we don't think we have any material direct exposure. I should also add the nature of the businesses we focus on tend to be quite defensive businesses anyway. So in sectors like IT services, healthcare, education, again with limited direct exposure. I think the thing that's more difficult to ascertain is what the the indirect implications of Trump tariffs might be in terms of a general European slowdown. And obviously that's a question that many commentators are contemplating at the moment.
Well, there's the point. It's about a growth shock, either here in the United States of America or indeed in the targets of tariffs. And we've yet to understand what he will do in Europe. In the event of a growth shock, how do you see financial conditions? Typically, they will tighten, but then you presumably have a scale of dry powder that you're ready to deploy. You probably would quite see the opportunity in a growth slowdown for you at some level.
Yes, we think about our businesses in two halves, as you say, Manna. So the first half is obviously our portfolio, which, given that we're making long-term loans, we do sensitize that for reasonable downward shocks. And we think the portfolio would remain pretty robust. Certainly, if you look at the slowdown we saw in Europe during the acute period of the Ukraine war, where we saw very high inflation, very high energy costs and so on, actually the portfolio proved to be very robust. If we were to have a very severe downturn, then obviously that would have implications, and I would argue probably in those circumstances, being in senior debt is probably quite a safe place to be. The second part of our business is obviously new investing, and as we saw recently with the slowdown in Europe, actually that creates tremendous opportunities for us, because typically in that environment we see banks retrenching aggressively. You know, we saw the liquid markets close to new issuance in Europe for 2 years, which is pretty unprecedented. And given that we have long-term capital, that creates great opportunities for us to invest when other people don't have capital.
Give me your perception at the moment. You're going to have a majority European companies. They may well have exposure to China. I'm just wondering, the sales processes that everybody was so buoyed up about, the exits, the sales, do you think that you're going to run into a headwind and delays on those exits? Will they be delayed, interrupted, denied?
Well, I think actually going back to what I said previously, we tend to focus more on kind of services type businesses, healthcare, education, software businesses, less on heavy industrial businesses. And that's a very deliberate choice on our part, because we do see, for example, as you correctly say, exposure of heavy industrial businesses to China as potentially being quite risky and quite cyclical. So in that regard, I think our portfolio is certainly quite defensive.
How much do you see Europe relative to the US on the back foot when it comes to deregulation? We're talking about Scott Bessent, the Treasury Secretary here. We'll talk to him later. Do you get the feeling that you're going to go into a period of more aggressive deregulation in Europe, or is that just a hope and an aspiration relative to the US?
I think at the moment it's probably a hope and an aspiration. I think again, we'll need to see what how the deregulation shapes out in the US. But I certainly wouldn't say Europe is on an aggressive deregulatory trajectory at the moment. I know, for example, in the UK, there's a lot of talk about deregulating the markets and freeing up those capital markets to attract capital from the US. But again, we're still waiting to see what governments and regulatory bodies are actually able to deliver.
Well, there's a distance between rhetoric and delivery. You were with Danny and I last summer. You're quite bullish on the M&A market. Look, we're running into these temporary headwinds, some people say, tactical trade wars. Do you still have that same optimism on the M&A business?
Yes, very much so. I mean, interestingly, last year, which was a relatively quiet year for M&A, Arcmont had a record year of deployment. It was our all-time greatest year of deployment. And part of the reason is a lot of private credit managers are very focused on the private equity market, and private equity firms, having sat on dry powder for 2 to 3 years, are coming back to the market quite aggressively. And that is driven really by two things. Firstly, valuations have improved, so they can exit businesses at better valuations and buy businesses, but also credit is beginning to flow and at slightly lower rates. So we are forecasting a very strong year in deployment for 2025. And I should add, we're also expecting to see prices and terms remaining pretty good. We're in a higher for longer base rate environment in Europe and elsewhere. And that will obviously increase returns to our investors, I think making the market extremely attractive.
Anthony, we wish you well with 2025. Come back and speak to us when the deals flow change. That is Anthony Fobel there of Arcmont Asset Management on Bloomberg. Your day ahead looks a little bit like this. Honeywell, Hershey and Eli Lilly all reporting. You've had that breaking news on Honeywell in the past hour. Bank of England is also going to be a critical focus for us. That is at 7 a.m. Eastern, followed by Governor Bailey's news conference at 7:30. And then we have Amazon, the earnings coming in after the market close. A real ruckus in terms of some of the movement of goods between here and China. I'll leave you with a snapshot of what's going on in the UK on the assets. We're expecting the third rate cut down to 4.5%. The talk is stagflation. You've got the pound at 124. FTSE is at a record high, so stocks are at a record high. You're expecting a downgrade to growth to 1% from 1.5%. And 10-year bonds at 442. Lizzie Burden will take you through that, and the surveillance team will take you through the next 3 hours.